My favorite quote that was out, I feel like every day this could be a quote in the paper, was this quote from last week. It said, given that so many potential issues remain unresolved, from debt negotiations and potential changes to the tax code in Washington to the pandemic, this person, the chief investment officer, expects the market's path from here to be bumpy. Like, come on. When is it not bumpy? When have you ever heard someone be like, smooth sailing, expect 30% return with no downside?
Do you think when that person reads that headline that they're embarrassed for themselves?
No, I think they're like, this is good PR. And I'm going to be right because it's going to be bumpy.
It's embarrassing. Welcome to Talk Your Chart, episode 8. Brett Horowitz, good to see you. What's on your mind?
Morning, Marcos. So the first thing that I'm glad we're not talking about today is about the debt ceiling limit, which has been extended out for a few more months. I don't know about you, but that's been in all the headlines over the last few weeks. And I was surprised because I thought this was a relatively new phenomenon, but I was surprised that over the last 60 years, since 1959, roughly, the debt ceiling has been raised 87 times. So to me, I look at that and be like, this is just another example of making a mountain of a molehill.
I agree with you. That's a wonderful stat. You said 87 times?
87 times since 1959.
Okay, I was born in 1987, so I'll never forget that. That is crazy. So let's real quick run down. The debt ceiling is establish a debt ceiling, which is a fake limit on how much debt we can issue. Then Congress approves legislation that will require new debt in the future. Then that legislation breaches the debt ceiling. Then everyone pretends that they're going to default and they grandstand this whole thing.
Right.
Then the government shuts down for a week or two. Then the debt ceiling gets raised because legislation gets passed. Rinse, wash, repeat. I'm paraphrasing from Colin Roche thing that I read.
It's expenses that have already been spent. So we just got to come up with money somehow. It's like having a credit card with no limit. Like, just raise the limit. That's all that happens.
I know. Yeah. But yeah.
So anyway, the real topic that I want to talk about today is about high yield debt. So high yield debt, for those that don't know, refer to those companies or municipalities or government organizations, whatever it is, that are speculative, right? That are risky. And I've got an example from last week that I read. So it has to do with this company Evergrande out in China that's producing all these properties that no one's now buying because they overproduced. And another company, another peer of theirs called Kaiser Group. So I'm going to read about them. They defaulted in debt in 2015. Then over the next 5 years, spent $9 billion building more homes. And then finally, last year came out with debt that was going to be offered to people at 8.65%. Right. So that's your perfect example of a high yield debt. Right. Company you're not even sure is going to pay you back, but you take the risk because you're getting a high return on it.
Credit risk, precisely.
Credit risk. Right. So I look at that and say, okay, now if we come back to, now that's sort of a reasonable number, right? You're expecting a high return in order to get compensated for a high amount of risk. Let's look at what's happened in the US. And here's where my chart comes in as we're looking at here. You know, this is a statistic going back over the last 23 years, 1997.
Okay. And
pretty much during that entire time, interest rates on high yield bonds, or junk bonds as they're also known, have always ranged between 5 and 15%, with the obvious exception of the great financial crisis in 08-09. And now they're under 4% for a high yield bond. Compare that to a AA high quality US bond of 2.3. You're saying there is no juice left to squeeze for that high yield debt.
I knew we were going to do this. I knew you were going to bring it to the spread, because you're right. This is alarming is not a good word, because that would be too alarming. But this just speaks to where we are in this cycle, when the spread of high quality credit or high quality debt, the underlying borrower's ability to pay you back, is so close to what that high risk, you never know if you're getting money back type of borrower. So what signal are you deriving from this?
Well, I hope that, I mean, we're telling our clients, right, there's not a lot of reason why we'd want to put you in something to get an extra 1.5% for a lot more risk. I'll go into the risk in a little bit. But I know that when we talk to clients and they're looking at their bond portfolio that's yielding 1 or 2 or maybe 2.5%, they're saying, can't you do anything better? And the obvious question or obvious thing that they're going to do is they're going to look at either more risky bonds, longer term bonds, foreign bonds, anything that's got a higher return in order to try to make up for that loss of income.
Right. Whoever's telling you that you can go out there and get more yield relative to your bond portfolio is basically telling you, oh, sure, let's take more risk and then you can perhaps get more return.
Right.
It's impossible to step away from that. And if someone is telling you otherwise, take a step back and exit stage right.
Well, I think it's worked out so far this year, right? So you haven't seen.
It works till it doesn't.
Right. It works till it doesn't. Right. And so I think, a lot of people may not realize they have it in their portfolio, or if they're getting nice bond returns, they're thinking, wow, this person's a genius who's making money from me. But in reality, they're taking a significant risk. We know in our perspective, we put the bonds, junk bonds in the stock side of the portfolio because that's the risk we're talking about.
You're right. Let's just we'll talk out of both of our sides of our mouth here real quick. Our core bond portfolio that we're putting out there for clients does have a little bit of high yield bonds in the form of those open, more nimble managers that we have. So yes, we are without a doubt allowing that into the bond portfolio, but the magnitude of the allocation towards that is de minimis relative to the credit risk, right? That's not something that's going to blow up anyone's ballast, so to speak, right?
Right. Yeah, it's 2 managers and they have the ability to do that. It doesn't mean the entire portfolio is in that. There's limits to both of how much they can put in high yield bonds.
Yeah, precisely. And look, I know you've been involved in conversations about it with clients, the investment committee that I serve on, that's all we're talking about. And we're looking for the best thing since sliced bread. We've looked at annuities. We looked at private real estate. We're looking at structured notes. We're looking at defined outcome ETFs, all these products and all these things that just so happen are getting a ton of attention right now in the RIA space, the registered investment advisor space, because people are reaching for yield. And if everyone's doing it, that's a sign to maybe the path forward isn't let's go get more yield somewhere else. Maybe it's reset your expectations and make sure that your plan still works, assuming lower rates of return over the next 7 to 10 years, let's say. I think that's a more reasonable path.
The time to own high yield bonds is in 0809 when you're getting 20% rate of return.
I know. Yeah.
Right. And the world is coming apart and there's no way that every company's going to go out of business, but some will. So I looked up the default rates on different types of bonds. So I was like, I wonder how much different bond default rates are for a AA bond versus a single B, which is now not investment grade, versus a triple C. A AA, the highest 1-year default rate based on an S&P Global report was 0.38%. That's the highest default rate in 1 year, according to AA rated bonds. So AAA, the highest, AA, 1 slot below that.
Yep.
When you go down 3 notches, I guess, to a single B, right? Single A, then triple B, or maybe 4 notches to a single B. You now get to a 13.84% highest 1-year default rate. And when you go down a few more notches to triple C, 49% is the highest 1-year default rate.
What was give the cutoff on investment grade? What's the rating? So we all understand what's the letter rating that below investment grade starts.
So you have investment grade is AAA, AA, single A, and triple B. Anything at double B or below is what they call speculative or junk status.
Precisely. And what was the jump? What was the jump in default rate?
From 0.38 on AA to 14% for single B to 49% for triple C. So to get an extra 1.5% for those default rates, I mean, that's crazy.
Yeah, no, thank you. Right. And we, what do I always say? We won't sacrifice one night of sleep for a client just for the hope of achieving a higher rate of return, especially in a bond portfolio. No, thank you.
Right. This is someone's capital preservation. This is their safety money, not something that we want to dip our toes into.
Yeah. No, thank you. Good chart. That the best part of that chart is obviously the spike in 0809, right? Could something have been more of an obvious buy?
Yeah. I mean, we wish all bonds were yielding double digits or even high single digits as they were decades ago, but that's not the case. So
I know. Oh, you're teetering into the rising interest rate environment conversation, which we will have to table and perhaps bring up in episode 9 if they let us keep recording this. So let me say one thing I think is interesting to look at: yields, bonds. Let's just go to like sovereign debt, right? So the U.S. 10-year is about 1.5 right now. Germany, the Netherlands, Switzerland, all negative yielding debt.
Yep.
Right? If you want to go capture 5%, guess where you got to go? You got to go to India.
Greece.
You got to go to Mexico. Yeah, no, you know what Greece's 10 years yielding right now? Guess. Your dad's going to hate me, but guess what the 10 years yielding in Greece?
I guess it's under 5, so I'll go with 3.
0.93.
Wow, what a change.
Is that like not bonkers? Greece borrows at a lower rate than we do. Anyways, we digress. Good talk on rates. My turn, and I'm talking all about employment. So I sent you those charts. I just want to read off a few stats here. So unemployment pre-pandemic, when all this started, was it 4.3, right? Before pandemic hit? I think that was it.
I'll go with it.
Okay. So the unemployment rate in the US has now moved down through September to its lowest level since the start of COVID at 4.8%. This is a full point lower the historical average since 1948 of 5.8%.
And it spiked at what? Closer to was it 20%?
Say it again.
Was the spike? Does this chart have the spike?
Yeah, I think so. Look at it. U.S. unemployment. Look at the spike. That was all the way well north of 12. You're in the 23 or so, and it drops off a cliff to 4.8. Who saw that coming? Nobody. If they're saying they did, they're lying to you. They're 3 point. Now look, so that's unemployment. Let's back up, because now what are we talking about? We're trying to hire. Everyone's trying to hire, but no one wants to be employed, right? Or it's really, really hard to get employed. So what's happening? Right now, there are 3.3 million more job openings in the U.S. than unemployed people. Another record high. The labor shortage, what's it doing? Wages, where are they going, BH?
Up and up and up. Sorry to hire people for the right.
Exactly. So average hourly earnings are up 4.6% over the last year. There's your inflation. So what's this do? What's the knock-on effect? Companies get pushed to increase prices so they can maintain profitability. What's the best hedge of inflation, Brett? What does that mean? What's that tell you right there? What's
Buy
the best
stocks.
Stocks. Thank you very much. Thank you. Why? Because although it hurts in the short term, companies, they got to keep their margins, right? Also margins, highest they've ever been historically, right? So consumers obviously.
Hold on, because they did say this morning that the producer price index is up more than the consumer price index. And so
Yes,
what
exactly.
they're finding is that companies are passing on some of these costs to the consumers, but not all of them. So if this continues, if they find that there's any pushback from consumers about not being able to spend, then those margins get compressed and the stock prices are going to go down. So it's contingent on that effect continuing.
I totally agree with you, but that also shows there's a lag in them getting higher prices and then those then getting turned over to us. Although I did see a gallon of organic milk priced at just under $9 at the store. I did not buy it.
But then you can switch to something else, right? That's the real thing that you do here. If inflation gets too high, you switch to a different product.
Precisely. But how much that's elasticity, right? Is there an alternative? Can you go do it? What's almond milk trading at these days? What's badger milk trading at these days? I don't know what other types of milk there are. So look, what does this lead us to talk about is inflation again, like always. Here's what's interesting. Obviously, we have like the last 12 months, like a 5.5 reading on inflation. But have you looked at the 10-year tipped break even lately?
It's negative.
No, it's not negative. Of course not. You expect some level of inflation. It's dropped by a big percentage.
No, but
right?
if you bought a 10-year bond now, it actually has a negative yield.
Oh, 100%. Yes, without a doubt.
The break even is like 3% or something like that.
That's a better guess than usual. It's actually 2.5. Right. So your 10-year tips break even is 2.5%. For just to kind of define that, what the 10-year tips break even is trying to communicate to the market is what the expectation is for inflation over the next 10 years, right? So you can look at all the consumer surveys and consumer sentiment stuff that is showing a a subset of the population saying, oh, inflation is going to be 7% over the next 10 years, right? Don't look at those emotionally based studies. If you look at what the market participants are telling you, the 10-year break even is giving you 2.5. So where does that, how do you reconcile all that? Is that because there's going to be a big drop off? What I'll tell you right now is that I think there's a big difference between the actual rate of inflation and the rate of change of inflation. And I think this rate of change is not going to last for as long as headlines might think you to believe. The actual level could be elevated relative to historical, but aren't we kind of due for some of that?
It better come down. I heard yesterday there was a guest that was one of the managers of a hotel chain, and he was saying customers are paying whatever he wants to charge for a room, that he could raise it to, and they would pay whatever they were offering to get a room. And so I think it's considering that's the health of the economy, the health of the consumer, doing very good. But, and the fact that you've got, what was the number? I think it was like 3% of the entire country decided to quit their job in the last month or two. You know, you only do that if you're feeling good about yourself. You only do that if you have cash on the sidelines, or if you've got job prospects lined up, or some people do it because of COVID and other situations, but quitting is normally a positive when it comes to the economy.
Yeah. Why do you do it? You do it when there are 3.3 million more job openings than there are unemployed people, right? That's a supply demand thing.
Right.
That's it. Employees have more leverage.
Right.
That's just a fact. And especially when you get the scalpel and look at it more specifically, it's the restaurant space. It's the blue collar job space, right? We have clients that work with a lot of food manufacturers and food processors. They are having such a tough time getting bodies on factory floors.
And that has to change, though. That has to change, right? If the people can't find the jobs and the jobs can't find the people, then we're no better off having all those jobs and all the people out on the sidelines.
I agree with you. And who knows, again, how many factors play into being able to find proper job applicant fit. But what I'll tell you is, I know, at least from the small sample of the clients that work with those type of kind of blue collar workers, all those companies are looking internally to say, how do we reposition? How do we almost rebrand, give the position a little bit of a PR job to make it more attractive for a younger generation of worker who isn't, have you heard of the silver tsunami? And it's not a Marvel Cinematic Universe thing. It's basically saying all the baby boomers are retiring. What they were doing when they got into the workforce, they wanted a sweet 9-to-5 with benefits, an employer that they appreciated, and they were going to work hard for. What do the new employees want? They want to change the world. I'm exaggerating, but they want something that's a little bit more personally attractable. Think Maslow's hierarchy, right? Like they're really coming in saying, I want to be impactful with what I do. That's going to require a PR job on a lot of these blue collar jobs.
Jeans on Friday and every other Friday off over the summer. That's good enough for me.
Yeah.
We're running up on time. Final thoughts, Marcos.
Final thoughts. Final thoughts are, don't reach for yield. The best way to understand the level of risk that you need to be taking is whether or not your financial plan will be successful. That's it. What a boring last thought, but go, your turn.
Good enough. We'll leave it like that.
All right, man. Thank
Till
you.
Next time.